I'm going to show you an easy way to do a fundamental analysis for any stock with 3 easy steps. These are the 3 steps I usually take when I want to take a longer position. I usually swing trade, but sometimes I will take a long position on a stock because I believe that the stock overall is fundamentally sound and that the investors behind it will start getting more behind it or out of it if we find that it's not that fundamentally sound. So there are 2 ways it can go. Either you find out that the company is pretty solid and you want to go long, or you find out that the company is not going to be very solid and you go short. So the first thing you want to do is look at some industry related factors. Now for each industry this is going to be different. For example, I'm going to show you a tech example, but for tech what I want to look for is, does the company have a monopoly? So this could be does the company have a monopoly on anything? For example, Google has a monopoly on search engines, right? Nobody really uses Bing or Yahoo. Yahoo is Bing nowadays. Another example is Apple. In the past, they had a monopoly on smartphones and on tablets. Nowadays, there are lots of competitors, so they kind of lost that monopoly. Another example would be, let's go with Amazon. They have a monopoly on e-commerce. So although you can use eBay to get bargains on certain products, generally you can get anything you want for cheap on Amazon, and if it's something that's a commodity, you're probably not going to go to eBay. For example, you probably won't go to eBay to buy a USB cord. All right, so that's tech. You also have commodity-based businesses. For example, let's just use gold miners. For gold miners, you generally want to look at the price to mine gold versus the price gold is sold at by that miner. So you're going to see profits on gold miners who can make that margin wider. The more likely they are to mine gold at a cheaper price and sell it at a high price, the more likely they're going to be a good company. Now, interestingly enough, if you look at gold miners and you're going to be investing in gold miners, you want to also look at other industry related factors such as how many mines do they have, how long have those mines been open, because each mine has a lifetime, and if you're ending a mine, you're going to start losing some of that gold production. All right. Another example would be airlines. So airlines, you're looking at things like load factor, cost of oil. So I can't give you a idea on fundamental analysis for any stock because each stock is in a different industry, but you get the idea. Banks, you want to look at return on equity. Each stock is going to have its own industry related factor that makes it a good company or a bad company. I'm going to show you what I'd go through on a tech company in a minute. So that's the first thing you want to look at. And where do you find that stuff? Well, you can usually just Google it. Second is the management of the company. And I don't really like to dig into a lot of management factors. A lot of people like to look at things like, is there insider buying, or is the management buying stock in the company itself? Because if they are, that shows that they're confident in the company. And if they're selling the stock, it shows that they're not confident in the company. But confidence is just one thing. Some people care about that, but you'll also see people in a board of directors or in the management who buy lots of stock and then the stock price drops afterwards, and you're left thinking, why did they buy the stock if they knew that bad things were coming? Well, even management doesn't really know what's going to happen to the stock price in the future. So I don't think insider buying is a good measurement for the management. What I care about more than anything in the management is the size of the board of directors. Because a smaller board of directors size means that the company can change and move more quickly than any competition it has. If you have a large board of directors, things are going to get tied up in the meeting and you're not going to see the company move quickly. This is especially important in things like tech and other innovative industries. And the ideal size is usually seven. 7 people on the board of directors is great. More than 10 is not that great. And if you get up to the 20s and 30s, you're looking at a corporation that moves slowly and is probably pretty stupid at getting things done. They're probably going to care more about accounting than creating products. Um, they're going to let the accountants more or less run the company. And that's not a good thing if you have competitors in your industry. So look at the size of the board of directors, and you can just Google that as well. That's what I care about more than anything. Um, and then third, what I like to do is get a value valuation of the company. And what I use is one of 3 models. I often use the discounted cash flow model or the excess returns model, and sometimes I look at the liquidation model. I'll show you each of those in a second. All right. So with these 3 things, I can pretty much define whether the company is going to be good in the long term or bad in the long term. And when you're doing fundamental analysis, generally you're going to hold something for a longer term because all of these things, management, industry-related factors, and the valuation, are looking at the long-term trends of the company. For example, valuation usually gives you a new valuation every year. Industry-related factors are talking about long-term trends generally. Like if you have a monopoly, you probably won't have competitors for quite a while. And management tells you how quickly the company can move. But of course, a company is not going to move like within a day. If they're going to change things, it's going to be a rather slow change. Even though I'm using the term quickly, the changes don't come very, very fast in terms of your lifetime. All right. So let's look at these 3 things, and we'll just choose a few tech stocks. So why don't we start with the most popular one, which is Apple. Does the company have a monopoly? Well, in the past it did, now it doesn't. Just learning about the company itself gives you a good idea. And I like to go and look at Seeking Alpha and type in the ticker up here, so Apple. And then once you get there, click on Breaking News. And you'll get the most up-to-date stuff on that company, and it might change your outlook on that company. So right now I'm not really bullish on Apple based on this industry-related factor because they have too much competition in the smartphones sector and tablet sector and computer sector. All they really own right now is their brand and something that's very important, which is iOS. So they have the second biggest operating system next to Windows, and that's important for them, but it only goes on Apple hardware. So they have to get that brand in the hands of people, and they're basically these days just focused on that brand, differentiating themselves from people who use PCs. All right, so in here you can check out the news. If you see anything that looks promising or not promising, it might give you an idea. Everything I see here is pretty much bearish. It's telling you bad news. Apple was sued. This is good news. They're trying something new, which is great. You could just dig through here. Looks like some people are speculating that Apple will buy Netflix. That could be very useful for Apple. So dig through this stuff, find out what's real and what's just speculation, and compile a thesis on that stock. So for Apple, I'm still kind of bearish. I'm thinking it's not looking good in the future. You don't have Steve Jobs anymore, who made the company move fast, really fast, and focused on innovation instead of accounting. Now you got Tim Cook, who's doing a lot of philanthropy, which I don't think Steve Jobs was doing in the past. But that's the idea for at least industry factors. Now after that, I'd go and look at the size of the board of directors. So just Google that, Apple board of directors, and you'll usually find a list of board of directors. You just count them up and see how many you got. So in this case, that's executive profiles, board of directors right here. We got 8 people, including Al Gore. 8 people is pretty good. That's a small board of directors. So I would say this is a good company. In terms of management, they can move quickly. I don't care about the individuals. A lot of investors will dig through the individuals and see what they've done in the past. But honestly, you're not looking at single individuals here. When you got 8 people together, you're looking at a group, and there's groupthink involved. There's also the lingering mantra and rules of the creators of that company, for example, Steve Jobs in this case. So don't look too much into the individual profiles of these people. Look at the size of the board of directors, because that really tells you the most important factor of management, which is speed. All right, simple as that. And then finally, you should probably get a valuation of the company, or some statistical facts that are related to the fundamentals. Now, I'm going to show you some valuations of Apple in a second, but let me show you an example of what I mean by statistical facts of the fundamentals. So I wrote an article based on my study of IBM, IBM earnings, seeking alpha. And what I found through a statistical analysis, I believe it's this one, is that before earnings, or if you sell or buy or short before earnings, you'll find different patterns. So I noticed that the quarterly earnings per share were really high up every fourth quarter, and I ran a back test to see what happens if you just buy the stock before the earnings and you hold for a month and try it for each earnings report. Now, what I found was if you do it before quarter one earnings, you're going to lose 12% of your cash. And before quarter two earnings, you're going to lose 21% of your cash. This is good because it means IBM is worth shorting. So before quarter one earnings, before quarter two earnings, if you short the stock, you're to come out as having a profitable trade. Now, quarter three earnings really doesn't make any difference. It trends sideways. And quarter four earnings actually goes up. I made that bet this quarter four earnings, but unfortunately it went down this time. And coming up are quarter one and quarter two. So I'm probably going to be shorting IBM in quarter one and quarter two. And I believe the next one is, well, that's quarter four. But you can check that out, and that's enough to be considered fundamental analysis. Yeah, see, quarter four is not so good anymore. It used to be good, and if you bought that in the past, you would have made a lot of money. Anyway, that's a fundamental but statistical analysis. So you can mix statistics and fundamentals. Fundamentals isn't all just news and rumors. If you do so, you can find nice trades like this. And that alone can tell you what to do with that stock. So obviously with IBM, shorting half of the year, for example, shorting before quarter one and then getting out after quarter two, could be a profitable strategy. Now, what about valuations? What do I mean by valuations? You can look up certain valuations and calculate them yourself. I have code that allow me to evaluate a company based on certain factors. So I'm going to show you the discounted cash flow valuation. I'm going to do Apple, I guess, because we've already done Apple bearish, bullish, and we'll let this be the deciding factor. So there are three ways to evaluate a company that I use. There are actually multiple ways, but these are the three I like. Discounted cash flow is the analysis of what that company is expected to get in the future in terms of free cash flow. Now, future free cash flow is not as worthy, is not as valuable as free cash flow or free cash that you have on hand now. For example, $1 now is worth more than $1 in the future. So you've got to discount the future cash flow, and by doing so, you get a certain valuation, and you can compare that valuation of the stock to the actual stock price and see if it's lower or higher. Now, for Apple, it's always been very high. The discounted cash flow shows that the stock is probably worth something like $600, but it's only trading at $100. Now, that's pretty interesting because that's a huge difference. If you believe in this discounted cash flow model, it's saying that Apple stock should be worth $600, but it's not trading for that much. So what's going on here? It's obviously underpriced if you believe in this model. The fact that it's so different is interesting, and also you should be looking at the trend. You can see that the discounted cash flow model has been going down and has only spiked back up recently. But also notice that because it's so different and so far away from the stock itself, maybe it's not a very good model because it doesn't really follow the stock. Therefore, it doesn't really predict the stock, and it's probably not so useful in this case. So I would skip this model and go to the next one, the excess returns model. This model shows you how much you can get from investing in this company relative to investing in other companies in this industry. And by using this model, you can get a valuation for the company based on how well that company does with the invested capital it has at the moment. So when you give a company money, the company uses that money to invest, and for example in R&D, in the case of Apple, they do research and development instead of just reinvesting your money into bonds and stuff like that. So that would give you a valuation as to whether you should invest in this company, or if the opportunity cost is too large. And this model, we can see in the case of Apple, actually works quite well. As the excess returns go up, they almost exactly follow the stock. Now, according to this, the stock was a bit overvalued recently, but then kind of evened out in 2014 and then jumped up, and Apple started to follow that. But now the excess returns model predicts a much lower price for Apple stock. It says Apple stock's actually worth around $30 at the moment, which is really, really low, and we see Apple starting to dip down. So it is possible that the excess returns model does predict the stock price, and that investors should probably follow this trend to know where Apple is going. And in this case, we see that Apple is highly overpriced, and we probably don't want to buy it. So the conclusion for this analysis would be Apple doesn't have the monopoly it did before. The board of directors size is pretty good, but they've got to find something new. Otherwise, the stock is probably going to crumble based on the price that we see from the excess returns model. And these three things put together would make me bullish only in the long term, but bearish in the short term. Apple doesn't have much right now. It did have stuff in the past. The fact that the board of directors is small gives me confidence that Apple can turn itself around, find something new to market itself on. But for now, the company's investments are not doing so well, and I wouldn't want to put my money with them. Instead, I'd probably short, because the difference between the real value of the company and the stock price is so large. Now, the last thing we could talk about is that last model, which is the liquidation model. This model says that if the company liquidates at the moment, how much should shareholders get? Now, this is not a very good valuation. It just gives the lower limit. So when you invest in a stock, a lot of people worry that investing in that stock might cause them to lose all their money. For example, Apple might drop to zero. Now, that's probably not likely. Apple is only going to drop if it drops. The max risk you have is outlined by the liquidation model. So if Apple goes bankrupt and has to sell all of its assets, this model tells you how much money you would expect to get as a shareholder. In other words, it gives you your maximum risk when investing in this stock. So you can use this as a risk reward method if you're going long on the stock, but if you're going short on the stock, it could also show you your maximum gain. So you might want to short Apple and then see how much you can get, and it's showing right now that the maximum gain would be 20, or the lowest Apple would go to would be $21. It wouldn't fall further than that. That's pretty much its lowest support level. But notice that these are changing, and these have changed for a while. Back in 2012, the liquidation model actually showed Apple being, let's go back and get Apple stock price again. The liquidation model showed that Apple wouldn't drop further than 125. If it liquidated all of his assets, you'd be safe at 125, which probably meant that Apple was undervalued, because look, it wasn't even close to that. So when you find a liquidation valuation that's higher than the current stock price, that's a pretty good sign to go long in that stock. And if you had gone long on the stock in 2011, you would have essentially doubled your investment over the course of not even, well, a couple years. So that's it. Those are the three valuation types. So again, to review, My three-step fundamental analysis is look at the industry-related factors. You've got to know a bit about the industry before you can figure out those factors. Look at the size of the management, and then choose a valuation model. Actually look at all the valuation models and see which one makes most sense. I haven't updated the liquidation model code to plot the model with the stock, though that would be interesting. I might do that in the future. But you might want to do this by hand or code it yourself if you can code. In any case, that's the 3 steps. So if you have any questions, let me know. Please subscribe for more videos like this video, and if you have any requests for videos in the future, please let me know in the comment section below and I will make a video for you.